Happy Friday, Pat, and happy Veterans Day.
Yep. Happy Veterans Day to all the veterans out there.
Hope everybody's, a bunch of you have got the day off, but some of you don't. That's just the way the world works. Hey, I got to share this email I got from you. It's an example of real estate brokerage promoting a listing. I thought it was pretty cool and kind of unique. It's from OfferPad. And it said in the last 90 days, you participated in a sale, and they gave the address, Sapphire Way. And it said you're within roughly a mile of this listing. Not sure if you're working any buyers in the area, but this home is move-in ready. And he sends the link and everything. And they're going to have an open house on Saturday and one on Sunday. And what he's got here, open house content. If your client stops by the open house and says the word platypus, you, Rick, will be entered in a drawing for a $100 gift card. So first, kudos for reaching out in an unusual way. But secondly, I wonder how they arrived at the word platypus. Because that would have to be unique to me in order for me to be entered into the. So I don't know, just stuck out with me. But let's jump in with rates. We talked the other day that the CPI number was coming out when we did our Thursday night show. We pre-recorded that on Wednesday, but lo and behold, CPI came in lower than what was forecast, 7.7. They thought it was going to be, 8.1?
Yep.
And
around 8.
Yeah, and then the bond market like that. So right now, mortgage rates went from 7.2 to 6.9.
Actually, last week, 7, 7.8, 7.25 down to low 6.25, 6 3/8. No, they really from the lows recently they've dropped about. We should be actually doing jumping jacks. We're coming out of this podcast a little slow because that we had the biggest move in rates that we've probably ever seen on a daily basis. I should be doing cartwheels right now.
Yeah.
But it's can you see? Are you sharing my screen here?
Yeah, I'll pull it up. For some reason, your volume just popped up, so I made an adjustment there. And I got to check a text message to make sure it's not somebody from the show here.
Yeah. We saw this is the price of bonds. This right here was just an absolutely huge move. Biggest move we've seen probably. Well, Mortgage News Daily said since 2009, since recorded history. I don't know what's going on my screen here. This has always been like this lately, last couple of weeks. But this green spurt right here was an absolute game changer.
Yeah, it looks like it.
Rates short term. Basically, I'm going to show you what my screen looked like. I took a screenshot of it. I'm going to move it over here. This is what my let's see here. This is what my screen was. 206 was the price on the 5.5 coupon. The 10-year was down 27 basis points, which was phenomenal. So it was quite the move. It was a record move. It just goes to show you how on edge everybody is about the inflation numbers. And I think Barry Habib was spot on.
Yeah, you've got a clip of what he was talking about last week when he was forecasting what was going to happen.
Yeah, let me pop this in here. He's been
November 10th. It's a day we've had circled on the calendar for months, and we've talked to you about it for months. And as it turns out, we got the CPI report we wanted, and it's a lovely day. Just one day. Lovely day when you wake up and see the bond market's up 131 basis points, but we kind of knew that a good day was coming. We've been waiting for November 10th. And yeah, you could say it's almost like a Christmas gift here to see this wonderful green on the chart, 136 basis points to the plus side. And it's all thanks to what we thought was going to happen with CPI. As you know, we've talked about this many, 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 many times with you. And gosh, I've given countless webinars and talks and live events on waiting for this day, because we thought that we finally start to see the impact of all these Fed hikes, the supply chain easing, and inflation numbers starting to come down. And then the big one was the comparisons. Now, let's review this and let's break it down, because we got a CPI number today that came in just wonderfully for the bond market. Because remember, inflation is that's the arch enemy of interest rates, mortgage bonds, because it robs, it erodes the buying power of a fixed payment over time. So inflation is going to drive mortgage rates. So let's take a look here. We're going to break this down on a chart for you. So yeah, CPI, October 22, we got that today. This is the drop we told you was coming. Let's break down the numbers first. So the headline number was up 0.4%, and the year over year did indeed drop from 8.2 to 7.7. But the all important core rate, that's the one that the Fed's most concerned with, because it takes away food and energy, which the Fed does not have influence over. That was up only 0.3%. And that caused the year over year number to drop from 6.6 to 6.3. Now, there were really drops just about everywhere. Just about everywhere, this report showed declines, except for shelter. Now, that's a really good thing, because shelter is extraordinarily lagging. We've talked with you about this in the past. The way that it works is shelter really lags. But when we break down shelter, which we do, and nobody's done this, by the way. If you look, no one's talking about this number. And after we show you this stuff, it'll get out there and people will copy it and whatnot, like they always do. But here's what happened. Shelter was up 0.8% for the month. Okay, that's pretty stiff, right? And this was the big driver, because in core CPI, it's 39.3%. So even with shelter being up 0.8%, at almost 40% of the weighting, we still were only up 0.3. So everything else was really down, right? But hold on a second. Rents were up 0.7. And then the big one here, owner's equivalent rent, which is like 3 to 1 compared to rent, it was up 0.6. So how in the world is this up 0.8? How? Well, here's why. It's because of something called lodging away from home. And it was crazy. It was up 4.9% for October. Had it not been for this, we would have gotten an even lower CPI print by another 10th. This would have been up 0.2%, and this would be 6.2 instead of 6.6. And with a 0.2% number, which it should have been, we would have a real, I mean, we're having a celebration, but it would be even better than what we've got right now. But I want to show you, we call it crazy, right? Here's why we call it crazy. And again, no one does this, team. So please, when you talk about this stuff, you're going to be on the cutting edge, because nobody's talking about this. Look at this chart for lodging away from home. I mean, heck, if a cardiologist saw this, they'd be like, let's get you to the hospital. This is crazy. Look at how wildly this number swings. And here's where we are.
Let's break away from him for just a moment, Pat.
If we were down here, which we were just a few months ago,
so
you would have had like flat.
Put that on pause for a second. I have a question. Okay. So what is he defining as lodging away from home?
You know what? To be honest with you, I've been following Barry for some time, and I've never heard that before. This is the first time that I heard him talk about this, honestly. And like I said, I'm being honest, but I would imagine probably hotels. That's the only thing I can decipher. I'm gonna send Dan Habib, his son, an email this weekend and ask, because honestly, this is the first time I've ever heard him explain it like that. He breaks it down even further. So he says, that's it really kind of caught me by surprise too, actually, him talking about that. But because he digs into numbers that most people don't dig into, and quite frankly, I'm sure you just agree with me that he has been pretty spot on. He was the only one that's been saying these numbers. He was the one that was calling it the non-transitory back last March when they were saying it was transitory.
Yeah.
And he was saying, no, this is crap. And I started watching him and following him and reading stuff myself and started realizing that. But so he was the one that I've never heard of anybody else really in the last several months saying, hey, watch for October. We're going to start to see numbers subside.
Here's the interesting thing that's a result of this too, Pat. And this is, Here's Yellen warns U.S. may not be out of the woods yet on inflation. Of course, she was the one that was first saying that
Yeah, there
it's
was no
transitory,
inflation.
right? So
Yeah, it was transitory.
but anyway, we also have to look and go, okay, wait, she's in charge of the Treasury, so she knows how much money they're spending. So now you kind of have to believe her. Well, you guys, you haven't taken into consideration how much money we've actually spent that's about to work its way into the system. That's my little cynical state, because the central bank is pulling back, great, pulling money out of the system, putting the squeeze on housing. And I'm going to share some rent numbers with people too. So stick with me. I found a really cool site.
Yeah. So, well, the question is, they're I'm going to find out what he means lodging away from home. The only thing I can discern from that is hotels, and
that's going to be an interesting thing to look at.
Airbnb. I'm going to ask him. I'm going to try to get an answer from him the next couple of days. So,
well, and U.S. inflation has come off the boil, but it's going to take a lot longer to cool down. Now, he said housing was lagging, and that because even though, it's just going to take time for, it's not like even though house prices come down, your current payment isn't going to come down. So that's going to take some time for that to work itself out, but it'll show up on the rent side way before it shows up on the ownership side, right? And then here's market Yahoo Finance, U.S. inflation to cool only slightly, keeping the big Fed hike in play. So here's my question to you, and probably to Barry. Is the market now saying that they're pretty sure that that they're only going to go up 50 basis points?
He didn't really give anything there. He was just giddy that he was just doing jumping jacks all day with about it. Well, how the rates were doing.
I'm asked if I have a political slant at all. I have a financial slant. Couple of facts. One, they're spending a lot of money, more than we've ever spent. And whenever that happens, it circulates in the system. I don't care what party it is. If there's a lot of money spent, we end up with inflation. And Janet Yellen originally was saying that inflation was transitory because it was a problem with supply side. We have her on record saying that. Now she's saying, hold on, it's not going to be going out away as fast as we think it is, because they see the spending. She's the one that distributes the money, cuts checks, and that. So, it is what it is. So I don't care if she's a Republican or a Democrat. Math is math. And if it affects real estate, I'm going to talk about it. So, and it is affecting real estate. When you look here, Pat, listings under contract, that number has gone down below levels, way below levels we've seen. This is showing 2007 and 2021. I believe the darker one here is 2007. We're almost down to those levels right now. I think that may be the opposite. This is 2007. But anyway, our sales are just declining, and they're going to continue to decline as we get through the holiday season. But here's an interesting thing on new construction. At the consensus, the end of this article, talking about all the stats, there's a large number of homes under construction, and this suggests that we will see sharp increase in completed inventory over the next several months, and that will put pressure on new home prices. With mortgage rates above 7% in October, we also expect to see a further decline in new home sales. So is this recent downward tick in rates, do you think it's got glue to it? Is it going to stick?
I think, based on what Barry's saying, I'm just going off of what Barry's been tracking and, what he's projecting for the future. I think he's saying that the next couple of months comparisons, year-over-year comparisons, are going to be lower. So I think we're going to see, some sticking there as far as, I do.
But a long way from the 2% target, though, too.
Oh, yeah. I think, I think, you look at it, inflation is still here. We had one day. One day does not make a trend. But I think I think just personally, I think yesterday kind of spelled that break. It kind of put a ceiling on rates. Say, okay, we might not see 8%. I mean, I know some retail lenders were at 8, but they're backing off. But this could be. Yesterday could have been the shift just one day. You can always look back and say, yep, that's where it started. Because remember, look at the charts, how January 3rd rates crept, they started their creep up from last year. And they just, all of a sudden, it was just one of these, oh boy, here we go. And that was the break. I mean, maybe yesterday was kind of a break toward lower rates, over the next 3 to 6 months. Like I said, Barry's said that the comparisons are going to be favorable and could be the subtle shift that we're looking for. So, but I personally think, you look at the movement in the rates yesterday. The problem is lenders are not, what people don't understand is the 10-year was up 200, basis points. Rates were down, but the lenders are not going to pass that all along at one time. When rates do go down, lenders are very skittish about passing along all the savings to the borrower. It's like gas prices coming down. They don't come down as quick as they go up.
Gas prices, you're exactly right. They don't. And either does housing. Housing right now, the missing link for house prices to come flying down rapidly is lending is solid. And people are sitting at low interest rates, so they're staying put. Otherwise, we would be seeing that. We are at 20,300, which is lower than last week. The 7-day moving average hasn't budged much. It's just kind of staying put. And as we get into the holidays, we're getting fewer and fewer new listings coming on board. But we've seen listing growth go up the past month, but only about 100 units a week. And if we were in a real distressed period, in other words, I guess what I'm trying to say is lack of affordability doesn't cause a crash. And we have lack of affordability right now. It's hard for people to afford a home, but that doesn't cause a crash. Lack of affordability causes a slowdown and causes prices to back off, but it's lack of credit that causes a crash. So something has to happen in the financial markets. And then we're in trouble.
Yeah.
So it's, if the Fed, clamps down too tight for too long, then we'll see that. So they're walking this dance right now. And as you pointed out earlier in the week, you're starting to see that the Fed governors are kind of not all on the same page now. There's some saying, well, we might not need to go up as high as we could. They're not all singing from the same song sheet.
No. And I think if you look at it, rates, my personal opinion is that rates will be the catalyst the next 6 to 8 months. Values might fall 3 to 4 or 5%, but the biggest push for people to be able to afford something, and the quickest, is rates dropping from, say, 7 down to, say, the low percent range, 5% range. If they did drop and they stayed there 5.25, 5.5, because it seems like people would be settled into the 5 range. They'd be okay with that, because you see a drop, say from 7 down to 6.25. That's like I was just running some numbers at 550. You're looking at, it's about a $350, $400 a month difference right there from 7 to 6.25.
Yeah. I just don't want to see rates get down to where the market gets heated up again.
Yeah.
Because that'll just make the future correction even harder. So I'd like to see us find that sweet spot where home values are going up at their annual 3 to 4% rate, and the markets are, the seas are calm. So I don't want to see where all of a sudden the bond market's doing so well that we're, back at 4.5% and we're overheating the market again. That would be bad for people that are looking for affordability. And speaking of affordability, I ran into this website. Now it's kind of hard to view here a little bit. Let me see if I can, and I put the link in below for people that want to see this, but I'm always asked about rental prices. And here's other cities, how other cities compare to Phoenix. So Paradise Valley studio rent is down 7%. Peoria is down 22%. And then you see here, Chandler is an average studio is $1,345, up 12% annually. And this website has a lot of different analysis, like by neighborhood, Awatuki foothills, and then it shows you Phoenix, Arizona rent trends. They're coming down. Yeah, but they're still, they break it out studio 1, 2, and 3. And then it has a lot of useful information on it. So this might be a link you'd want to hang on to if you're trying to, especially if you're a landlord and you're trying to figure out the direction of rents in your market. Here's the average rent in Phoenix. So like I say, I've got that link down there below, and we'll see if that can help you. They've gone up like 3 to 4 points, seemingly done nothing for inflation. What we shared some numbers last week that showed that when rates go down, like when not so much rates go down, but when the central bank adds liquidity, prints money, for lack of a better word, equities and real estate get affected immediately, right? Stock market's going to go crazy. Assets, real estate start going up like crazy. And then, now I'm getting spam. That's just fabulous. But then when they tighten, the market gets affected right away. Real estate lags, but it does start coming down, and inflation is way behind that. So you can see over a 3-4 month period where real estate starts coming down if they're tightening and pulling back, but that you're going to look almost 18 months, a year out before you start seeing inflation go down to that base rate where everything started. So I apologize to everybody on these. I'm going to have to block a user here. There we go. Got rid of them.
What the hell?
So yeah, Taylor, most watching are not looking for an 18-year-old girl. I don't know how that, so I've got that blocked, but that's one of the things that's really been a problem for YouTube, for YouTubers that are out there, is unfortunately, I've got filters that I put in my comment section, and it filters out a lot of different keywords. So when I see them, I go back in and I add filters. One of them that I added was crypto. But then if people used the word crypto, it didn't show up in the comment section. It would be held for review. But then they weren't using the word crypto. They were using an initial. So I had to put the initial in the keywords. Now, after this is done, I'm going to go in and I'm going to add 18-year-olds. And I'll probably add the word babe, so whatever I could do to do the filters there. But so coming up next week, there really isn't any financial data coming out that's going to move the markets next week. There's no unemployment so we could end up with a very less volatile week than we did this week.
Yeah, well, we are. I mean, we obviously the next step is going to be wait for the the CPI numbers coming out, and the Fed in December. But I think this kind of broke this 6 to 8 month chain of just pain that we've been experiencing. I mean, I think we got a tourniquet yesterday, kind of maybe provided a little bit of a tournament. On spam just means your channel about to blow up.
Bad news is good news.
Yeah, really. So I think, like you said, we're going to see the volatility. I mean, like I said, once again, a lot of people get excited, saying you're going to see a lot of news. Rates are in the 7s, but no, they're really in the low to mid, 6.25 range, because the Freddie Mac survey always goes back. They do it Monday and Tuesday, so they didn't catch the activity on Thursday.
Yeah.
So, it's a lot of good things. Lenders were obviously, there was probably some repricing, renegotiating, but the rates dropped for people that locked here recently. I was running some numbers, and a lot of these lenders now, you have renegotiations on if rates drop. The problem is they charge you like a half a point. It costs you $2 or $3 grand on a $500,000 deal. And if you're looking to refinance in the next 7, 8, 9 months, there's not enough savings for you to, really renegotiate if you locked here recently, if that makes sense. To spend $3 grand, because if you do refinance in 7, 8, 9 months down the road, you need more of a longer term to have that renegotiation pay off. So, but they did drop. I mean, they dropped from, like I said, the low 7s to low 6s, and this might be kind of put a finger in the dam in terms of the rush.
Well, if rates don't drop any further, but they remain relatively stable, will we see improvements in the points that you need to pay or lending fees to get?
Yeah, eventually, but you need to see sustained. You always need to see kind of a sustained period of time because, like I said, lenders, they have to protect themselves too. And like you said, when their bottom line is at 7, they go into a little bit deeper. I'd say it's 7%. They might pay 102 for a 100. Barry does go into this. He explains it, but lenders pay for the servicing rights. They pay 102 versus 100. If rates drop from 7 to 6, they just paid that 102 for something that's not going to stay around that long.
Gotcha.
So that's why you see them. That's why their premiums or their money that they pay out disappears when things are so volatile. And it's a stressful time on trading desks, lock desks, because I just wish we go back to the days where things were a little bit more stable. It'd be nice.
The other thing to watch between now and Thanksgiving is Open Door. They're now 11% of our total inventory from 300,000 to 600,000, and they still have 1,400, 1,500 listings. If they are intent on writing off Q4 as a huge loss, then they're going to have to do something real quick, because if they don't have a big fire sale between now and Thanksgiving, then they're just not going to. They're going to just keep doing what they're doing. But if they want to clear these homes off the books, they may end up selling 200 of them a block at a time to big wholesale investors, use them as rentals. But they only had 200 contracts last month. So that number from 1,500 is just eking down very slowly, and they want to be at about 400. So if they're going to deep discount by the end of the year, it's going to happen next week or the week after. After that, you won't have closings in time. They're going to want to close before January 1st. So that contract's going to have to be written probably right before Thanksgiving. The Freak says, feels like confidence in all areas of life is down. If I were still married, I'd put her on GPS just because I'm paranoid and future cloudy. I won't. Yeah, I'll let you have that one. It is. I mean, it's. But we showed that chart a while back where it said we're at pessimism, but we're not at despair. And I don't know if we're going to see despair because the psychology cycle that you shared. Want to remind everybody we're having our meet and greet this Wednesday. Thank you for all that signed up.
Tuesday,
the 15th. But I have another idea I want to run by everybody. Let me know in the comments section what you think. What I want to do, I'm hosting this one. So I want to do a non-hosted meet and greet about once a quarter at different parts of the valley with YouTube real estate creators and you, the subscribers. And I want to find a place where so you can go there and Pat and I'll be there, and probably Jackie and Caitlin McKeag and other area YouTubers. And we'll just have a opportunity to meet each other and shoot the breeze about real estate and say hello. And so I'm going to do that about once a quarter. I got the idea from a YouTube guy that does this in Las Vegas with a whole bunch of YouTube creators. And they just announce meetups in Las Vegas, and people come from California and Arizona and go up there and just kind of mingle and talk about, what they do at YouTube. I thought it'd be fun if we put something together like that. We could just say, hey, we're going to meet at Culinary Dropout on such and such time. And I'll have I'm going to put a link together where you can sign up to be notified when we're going to have a meet and greet. And then we'll just see how that plays out. What do you think, Pat?
Yeah, that's a good idea. Yeah.
So
for that.
And it'd be fun to invite the other YouTubers that we see on here. And I mean, it's all one big happy family. So,
yeah. So I'm going to get clarification on lodging away from home, since that, like you said, I saw that, him talking about that yesterday. I'm like, what the hell is he talking about? Lodging away from home? Are the homeless now renting hotel rooms or what? I don't know. So, I'm sure that's lodging away from home has got to be hotels and maybe Airbnbs, but
it must be because the Airbnbs have to be a big number.
Yeah,
in-
I'm gonna
in-
get clarification. So he
Okay.
said that was wild. That was the wild number in the in that you saw him explaining it a little bit as far as surprise. So
Yeah, and again, the
We'll get
central bank doesn't look at food and fuel because they can't control that.
yeah,
So, they look at the core inflation without that. So it's going to be interesting to see what goes. So we've got their December meeting coming up. And so we'll see what happens. But in the meantime, I think between now and then, unless there's some other surprise numbers, and it looks like things may just be calm for a while. Calm waters
Yeah, I
before the
think-
holidays.
it seems that way. It seems like things are kind of going along with the theme of being stalemated. I mean, people buying and selling. The people I've been talking to, they're kind of surprised by, they're, I don't know, I haven't had too many people, you quote them, say high 6s, 7% or whatever. It's like, okay. They're living with it for right now because they feel that rates are going to come down. So
Yeah. Well, cool. Well, Pat, have a excellent Friday and a great weekend. And for everybody out there, have a good Veterans Day and a stressless weekend and have fun. Take care.
Take care, everybody. Bye-bye.